for taking the time for being at our panel. I am joined by Ahmed Gharzuddin from MamoPay and Sunil Gokhale from VentureSouk. Well, gentlemen, welcome. If you could just take a couple of minutes and introduce yourselves to the audience, please.
Thank you so much. Hello, everybody. Good afternoon, or good morning, technically. My name is Imad Gharzuddin. I'm the co-founder and CEO of Mamo. Mamo is a fintech, and it's the team behind the MamoPay suite of products. MamoPay is a full-stack payment services platform aimed at helping individuals and SMEs save over 90 billion minutes per year across MENA by using products that are faster, friendlier, and simpler to use.
Thanks, Ahmad. My name is Sunil Gokhale. I'm one of the general partners and co-founders of VentureSouk. VentureSouk is a MENA-based venture capital firm focused globally on early stage tech. Most recently, we launched a MENA-focused fintech fund focused on early stage fintech startups in the region.
Thank you both. Sunil, let's start with you. With your interest in fintech, what is it that you use to assess a fintech on whether it's a good fit for your investment strategy?
Sure. Well, I think the criteria we look at or what kind of goes through our minds when we're looking at a potential fintech opportunity is really the same as any other sector. You know, you're looking for founders, best-in-class founders. You're looking for obviously, market opportunity, large TAM, which we see, tons of white space here in the MENA region. You're looking for, and this kind of relates to the founders, but you're looking on kind of, real focus on product. Is the team looking to build, the best product in its subsegment within fintech? You're looking at competitive landscape. So these are all things that you would, anyone in e-commerce or mobility or any other kind of any other segment of tech would probably look at. I think the thing that potentially is different when you're looking for looking at a fintech, a potential fintech opportunity, is previous experience in financial services, because I think that helps to address the point around understanding pain points that the particular founders are building to solve. I think that's key and ideal in a team, and I also think it helps because fintech is typically a highly regulated segment, and so founders that have learned to deal, frankly, with sometimes massive pain points around regulatory kind of coverage of their product oftentimes doesn't happen in other subsegments to the extent that it happens in fintech. So having that familiarity, or at least the expectation and kind of experience of dealing with regulators, oftentimes comes across with founders who have worked in financial services and kind of related fields.
So does that include founders that have failed previously? What's your stand on founders that may have tried and failed in the past?
Absolutely. It's interesting in the U.S. And other more kind of advanced technology markets. Kind of having one or two or three failed startups is almost like a badge of honor in terms of the learnings that have been kind of pulled away and hopefully used to make the next one successful. The region, we're still a bit early, and failure at least 3, 4, 5 years ago was looked at as kind of like a black mark, and we're not going to deal with that founder because they failed. Now the reason for failure obviously is important, but for us, absolutely a failed or a flat startup is definitely not something that would in and of itself make us shy away from a particular opportunity.
Awesome. Hamed, partnerships is very important in the success of a fintech. What do you see as the role of partnerships in scaling, and what do you specifically look for in a partner?
So yeah, that's a good question. So I think partnerships are, especially in fintech, they're more important than other sectors. In fintech, you can't really build a company on your own. You can't afford to build every single component of your company by yourself. Things like KYC, screenings, onboarding, etc. All you want to rely on different partners to help, right? So I think when it comes to partnerships, what you look for varies depending on what stage you're at as a startup. In the early stages, you're not necessarily looking for the same things you're looking for in the late stages. I'll give you an example. When you first start as a fintech, one of the core things you require can be as simple as a banking partner or bank account, down to partnerships with the schemes, Visa, MasterCard, Amex, etc. And then you want to, what you want to look for in those partners at that stage is someone who believes in your vision, in the team that you've built, and is taking an early bet
That's
on
what
you
I'm
as a
here to
startup
just
because you may not
take
succeed, you
everything
may
away,
succeed.
so you have
So you want someone who's aligned on the vision that you as
Pleasure.
founders and as a team have. But then later on, as you kind of grow and get into the scale phase, what you're looking for is slightly different. At that point in time, you've secured those partnerships. They're with you, hopefully, for the long term. And at that point in time, you're looking more for reliability. So if you're looking for a tech partner, you want products that are reliable, that are actually going to help you go to market faster. You're looking for a partner who is able to offer strategic advice and strategic posturing for you as a fintech. And you're also looking for a partner who's able to give you reach. So as you grow, you're obviously, especially in the MENA region, it's not enough to tackle one market typically. So you want to look for a partner who's going to open up doors for you when it comes to geo expansion. But across both phases, whether you're in early stage or late phase, I think what's important, and it's always important to go back to first principles, are the partners that you're talking to and looking to gain, are they aligned with you on the core principles and values that your company has? And that sets an amazing stage for developing that partnership in the future and making sure that you make the right choices that are rooted in very deep reasons for that partnership, right?
So that sort of brings us back to the point of growth and scalability. Now, I know you're growing geopolitically across MENA region at the moment with your full payment services stack. Do you put emphasis on scale or profitability?
So I'd like to say both, but in the past, let's say 6 to 12 months, I think everybody here is aware that the landscape's slowly been changing, and the environment, the market conditions, and the environment have slowly been changing. And fintechs today are being held more accountable towards profitability and healthy unit economics, more so than they were, let's say, a year or two ago. I think scale is important, but it can't be the only thing that startups are looking at. You have to do it sustainably. At Mamo, we tend to look at things from 3 different lenses. We always look at user desirability. Are the products and solutions we're building wanted in the market? We look at technical feasibility. Are we able to build what we're building, all the products we're building? And we look at also a very important one, which is business viability. It's one thing to build amazing products and scale, but you have to do it sustainably and profitably. And that lesson or that kind of principle tends to be forgotten, at least 2 years ago, where growth at all costs was okay. I think today that's no longer the case. So whether you're taking a new product or a new feature or cracking a new market, I think it's important to, as you test and experiment with launching your product, you also want to test and experiment with the business model, how your unit economics are faring in the market, and make sure that those are healthy before you, open up the floodgates, so to speak, when it comes to financing growth there.
Sunil, from a VC perspective, same question: scale or profitability?
Well, I know these days the politically correct answer is profitability, but let's be honest. If you're talking about the VC from a VC lens, we are in business to invest in high growth companies. I don't think fundamentally that's changed. I agree wholeheartedly with what Imad has said, is that you have to be kind of looking for sustainable growth, healthy growth. I think now it's not kind of, on April 1st, tier 1 VCs globally kind of woke up and said, okay, tomorrow we want all of our companies to be profitable and no longer invest in growth. That would upend the overall premise of what venture capital business is all about. I think what is now in the last 6 to 12 months started to happen is exactly what Imad said, is that you need to be able to see, the growth needs to be healthy, and there needs to be a sight line to profitability and healthy unit economics. It doesn't have to be tomorrow or the next day or even the next year, but I guess VCs now are paying much more attention to kind of the sight line into where this business is going, and growth. I absolutely agree with that statement, that growth at all costs is absolutely a no-go now, and never really should have been. And I think for us in particular, and why we like fintech we like fintech for a variety of reasons: market opportunity, a lot of white space in the region in particular, but we also like particularly kind of software businesses because of the low capex requirements, the ability to drive down or lever down operating costs and build kind of in a sustainable way with healthy margins. So I think for us in our portfolio. I think that's always been something that we've been looking for, and I think now it's just getting more attention.
So, what is it that you look for when it comes to assessing scalability, both internally and externally?
So for us, Imad's point was a very good one. The MENA region, it's very challenging in almost all cases to build a unicorn in one market. It's not the U.S., it's not India, it's not China, it's not these countries where you can build in one city and kind of move across and easily build a unicorn in essentially a single market. Here you need to be able to move across borders. So if you're starting a business in the UAE, you've got to be able to get to Saudi, you've got to be able to get to Egypt, you've got to be able to get the rest of the GCC in some form, typically to build a unicorn. So for us, we look at the team and the product, and vis-a-vis the lens of the product that they're building, the ability to take that product and take it across borders. You look at some, it's not a fintech, or it's not a fintech yet, but you look at a business like Kareem, it was able to get to where it was able to get to because it was able to move into multiple markets relatively easily when you look at comparative to other business. So for us, it's from a regulatory standpoint, do the founders have a handle on that? Do they understand the ability and what the regulatory requirements are going to be in the markets that they're going after? Are they picking the right markets based on the regulatory coverage? And also, it's not just regulatory. Do the founders have the ability to attract talent in those different markets? Hiring in Saudi versus hiring in UAE versus hiring in Egypt are completely different. Do they have the ability? Do they have the ability to actually go out and do that? Do they know how to run a team remote these days? Because you're not necessarily going to set up offices in those places. Running a remote team versus running kind of an office in one jurisdiction is totally different. So for us, it's the ability to move across markets is the key to scalability in the region.
Hamed, how do you plan for product market fit when you're building a pan-regional business?
So let's first talk a little bit about product market fit and what that means. So if you Google it today or ask anyone, it's very hard to get a very precise answer on what product market fit is. We tend to think of it as building a viable product that your users want at a price they're willing to pay, finding more of those users, and doing so, running this entire operation sustainably and profitably. So when it comes to that question, and when you're kind of planning for product market fit in one market, what you build in one market and how you do it may be totally different than what you do in the next market, depending on the pain points of the users in that market and the problems you're trying to solve. So generally speaking, if you're launching in one of the markets that Sunil mentioned, like China, US, etc., one of the larger markets, you have kind of one type of user who has a specific problem, and you're solving it with the product that you launch, right? Pan-regional, when you're talking about what UAE, Saudi, Egypt, etc., it's really important that you do a little bit more future-proofing of your hypotheses as a startup, and kind of think to yourself and do some research that suggests, is the problem I'm solving in the UAE going to exist in the other markets that I plan to get into? And if that's the answer, you need to adopt a very iterative and experimentation-friendly mindset as a startup, because it's really important to validate and test your theories very quickly. We call it failing fast. So if you overplan and try to spend 12 months building a product before you take it to market and test it, that approach typically is not going to work. So to answer your question on how do you plan for product market fit pan-regionally, I think trying to underplan and experiment more often, supplementing that with third-party research and speaking to users in all the markets you plan to get to, taking all that feedback in and keeping the product team, the growth team, all in the loop on what exactly the conversations you're having with your users are. I think that's the best way to get to product market fit as fast as possible.
And Sunil, is that approach also favored by venture capital?
Yeah, I think Imad made a good point. I don't think there's a universal definition on what product market fit is. I think people use the term a lot, but people have different conceptions of what that is. For us, in one of our portfolio company thinks about product market fit from a standpoint of, get me one transaction. That's the kind of North Star transaction. And if I can find one transaction, I can find 3, and I can find 8, and I can find 12, and it's being able to do it once, which is an interesting way to think about it. For us, and it depends on the business. For us, what we look at is the business. Are the founders, have they been able to sell the product or get people to use the product at a price, that's kind of that people are willing to pay, and are they able to do that organically at the beginning? Like, are you able to grow from 1 to 4 to 12 to 25 to 50 to whatever, even in small increments at the beginning of the life cycle of your business, with next to nothing in terms of marketing dollars? If you're able to do that by word of mouth and have real organic growth, at least at the beginning, then it's, for us, that's kind of like, okay, they've got product market fit, and that's when it's probably the ideal time for them, companies, to start thinking about, let's go out and raise some money, potentially put some marketing dollars in this, or hire some more people to tweak the product. But you need to be able to see some of that at the beginning to say, okay, at least early signs of product market fit are there.
Fantastic. So I think we're almost coming close to time. We'll do a quick lightning round and then maybe open up to a couple of questions. We may have time for a couple of questions, veering a little bit away from scale and profitability. And these are quick one-word answers. Obviously, Sunil from a venture capital perspective, and Ahmed from a fintech founder perspective. Open banking, yes or no?
Who first?
Sunil.
Yes.
Yes,
Ahmed.
for me as well.
Preferred exits, IPO or acquisition?
Acquisition.
IPO.
IPO. Maybe take a minute and explain the difference there. Why would you go for acquisitions?
I think with IPOs, you do have the potential for kind of a bigger potential return, but they're farther and fewer between, particularly as we think about the region. That might change. There is more IPO activity, particularly in Saudi, here in the UAE. But for us, who are primarily focused on B2B fintech, acquisitions by financial institutions, regional and international, probably makes more sense for our portfolio from a likelihood perspective.
So on my end, I think from a startup point of view or a fintech point of view, you've invested a lot of your time into what you're building in order to see it come to fruition, and it's a long-term investment, and you want to see it succeed. I think acquisitions can be good, but if you have the mindset of acquisition from the early days, you're probably going to be taking shortcuts when building your startup. But if you have the mindset of, I'm in it for the long term, and I'm here to build an amazing company with my team, that tends to end up with much more long-term sustainable decision-making internally.
Okay. And with the looming recession over our heads, optimistic or cautious? Sunil.
Regionally or globally?
Both.
Regionally, cautiously optimistic.
So for startups, I think you always have to be cautious. It's like a de facto way of operating. But at the same time, in looming recessions, that's when true business models, sustainable business models are going to surface. So it's a very nice Darwinian filter, so to speak.
Fantastic. All right, that sounds great. Team Nihal, do we have a couple of minutes? Should we take some questions? 2 minutes? Does anybody have any, 1 or 2 questions? Does anybody have a question for either Sunil or Ahmed? No questions. It sounds like we answered all of the questions already. Thank you, gentlemen, for taking the time. Thank you to the organizing team, and
Thank you,
have a
guys.
wonderful day.
Thank you so much.
Cheers.